Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to form your own financial opinions and make your own financial decisions. Today is Wednesday, November 17th, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we're going to start a special series this week, and it's going to be all about crypto and what the heck is crypto. Crypto is something that Viper has really been into recently. He's made a lot of trades. We've had lots of video on crypto. Quite frankly, I'm a little bit feeling that the bots haven't been visiting the latest videos as much, and I think it's because we haven't been mentioning much about crypto. So we're going to start at least 4-part series on crypto. We're going to kind of evolve it. If you guys have certain aspects that you want to see, I want to give a shout out to our Discord. So there's a link in the description below. Hop in there and tell us what you wonder about crypto, and we'll try to incorporate the answers to those questions in future episodes in this series. So without further ado, we can hop to the crypto stuff. Viper, it's been many years, I think, since I was hip to the crypto chatter, although it's consuming a lot of the mainstream news these days. What do you got on crypto here?
Yeah. So like you said, we are going to discuss what is crypto, and the purpose of this series is really, yes, investing and whatnot, that's a part of it. And I know that's what a lot of people want to just like, I just want to get in, I just want to invest it, but that's not what we do. I mean, we want you to learn the foundation of what you're doing. What is the thing? And that's, to me, that's important. But the purpose of this series is to be pretty high level. I mean, we're going to like drive the car right alongside the road of a whole bunch of weeds. And I'm all for getting in the weeds, and I'm not claiming to be a professional by any means on crypto. I mean, I'm continually learning, and I'm just at a point where I feel like I've learned enough that I can kind of throw the rope behind me and, kind of get some other people up to speed, but I have so far to go. So that is to say, we're going to try to keep it up above the belt, but still touch on the hot button things. We will get into trading and investing. And if there is something in particular, a certain angle or something, we would certainly be happy to add to the series, put a part 5 of top requested things or whatever. I mean, any excuse to learn more is certainly fine by me. So with that, let's dive in. Here is an overview of where we're going to go with this series. So we're going to start with part 1, which is what we're going to discuss tonight. Part 2, 3, 4 will be coming in the future. Subscribe to the channel, all that good stuff. Hop in the Discord. It's probably about time we start a crypto channel in Discord, but I mean, certainly if the interest is there, that would make sense, and it'd be a great place to keep up to date with that. So part 1 is going to be, what is a blockchain and how does it create currency? And that's going to involve talking about how mining works, the difference between a coin and a token. I know that a token is especially brand new concept there to Sprocket, because he's OG just Bitcoin. And then try to loosely answer the question why you should care about any of this. Part 2, we're going to dig into NFTs, dApps, DAOs, DeFi. Oh my. Just the hit the nuts and bolts that, well, NFTs aren't necessarily the finance side, but the dApps, DAOs, and DeFi are all sort of the finance nuts and bolts of what's happening in crypto right now. Then we're going to go to part 3, which is an area that I am particularly interested in and particularly excited about, and that is the area of crypto gaming. I believe the collision of gaming and crypto, I think is one potential catalyst moment that really sends crypto into the mainstream. And we're going to talk a lot about metaverses there, not the company, but the concept. And then part 4, get into investing in crypto with DEXs and CXs, and just where you can, where you could trade this thing, or what's out there, and the pitfalls of what's out there. So that's where we're headed. Real quick. So what's your foundation, where you started, how you came to know Bitcoin? It's booming enough that it's becoming a thing to be able to have that badge on your shoulder of I was there.
Yeah, Bitcoin. Bitcoin's where it started for me, and about where it ended. But yeah, it was probably back in, I'm gonna say, 2010 ish. Um, I was really into just computers and programming and hardware and all that stuff. And in the nerd circles back then, I still think Slashdot was relatively frequented a little bit. But there was all this talk of this cryptocurrency and this Bitcoin. And I was like, man, what's this all about? And the more that I read about it, the more I'm like, wow, this is actually kind of neat, where I really liked cryptography, security, all those kind of things. And this was like an application of cryptography where, you were chaining these transactions in this public ledger, and everybody was applying the signatures to them. And the only reason that everybody trusted it was because everybody's computers did their own calculations and said, yeah, this kind of checks out. And at the time, Bitcoin was probably worth, it was definitely less than $5 a Bitcoin. I think when I really started following it, it was around $1 or $2 a Bitcoin. And I was really a hardware geek, and I was like, wow, what is this? You can mine them. You can come up with these on your own and discover these chunks of Bitcoin that hadn't been just discovered. And really, it was just solving a math problem and having a computer solve the math problem for you. And if you got a particular solution, you submitted it to this world, and they would validate your calculations and say, yep, you got it. If I recall, back then, I think when you solved the math problem, you got like 50 Bitcoin.
Yep.
I could be wrong, but it was something like that. And I said, I got to get in on this. This is just fun. Not so much because I thought this would be worth something someday, but more from the aspect of, I like the math and the calculation and the hardware and making a computer do something about it. It was kind of like the, what was the thing called, SETI, or the search for extraterrestrial stuff that even predated Bitcoin. Yeah. You'd basically like turn your computer into this mindless thing of churning math calculations and submitting results back. It was kind of like that. And I was like, wow, how can I make this hardware work? And so I spec'd out a computer. It was like a rack mount chassis, and I bought 4 GPUs, like top of the line GPUs. Put them in there. I mean, I sunk a lot of money in this thing, and I'm like, I just want to make this thing work. Like, I never actually ever anticipated to get my money back out of it. And this thing pulled about 2,000 watts of power when it was running, and I distinctly remember in the wintertime it would heat my basement. I couldn't actually get enough fans on the thing in the chassis, and so what I ended up doing, it was a rack mounted like 3U chassis. I just pulled the cover off the top and bought a 19-inch box fan and just tipped it sideways and laid it on top of the chassis, just because I couldn't get enough airflow to keep it cool. So anyway,
still a popular form of cooling.
It was very effective. You get all these little case fans, and they're whirring, and I never could move enough volume of air to cool this furnace, basically. Yeah, and so I never actually discovered a block of Bitcoin on my own, but I quickly found these like mining communities where everybody would kind of chip in, and when a block was discovered, they would keep track of how much calculations did each participant do, and they would divide up those 50 coins among those people. And I remember getting to a point where my miner was basically coming up with, 1 Bitcoin a month, 1.7 Bitcoin a month. And at the time I was like, wow, this is taking a lot of electricity. And I did like cost calculations on how much am I paying for electricity versus, how much is this worth? And as long as the Bitcoin was above like 250 or something, like I'm like, yeah, I guess I'm not losing money if I ever decided to sell these things. And that was really where it kind of went. You know, I started fading out of it later as some of the hardware miners like the ASICs and stuff came online, because they just completely dwarfed the computational power of my furnace, for a fraction of the power demands. And so then I was like, yeah, okay, this is kind of old school. And I kind of tore down the miner and sold the video cards to gamers and things like that. And, but yeah, that's kind of where it started. It was super nice. In fact, I even remember getting to a point where I had amassed enough Bitcoin, and places were just starting to surface where you could like buy them, like pay money and pay for things on Bitcoin. And it was all like weird stuff. The only purchase I actually made was I bought VPN service, specifically so I could watch the Olympic Games. It was one of the first years I think NBC took over the rights to the Olympics, and I wanted to watch sailing, and I didn't have a cable subscription, and I wasn't going to pay NBC, so I paid for Bitcoin and I VPN to another country and watched the Olympics. But yeah, that's
the most expensive VPN service you've ever paid for.
Yeah, it probably was. Like I said, when I had it, I mean, towards the end, it got up in the thousands of dollars a Bitcoin. But yeah, nothing like today.
Yeah. Yeah, I specifically remember it was around that, like you said, $2.50, $3 or $4 was the cutoff, because if the price ever fell below that, then it was shut everything down and wait, and then it would come back up. And the irony of all of this is, I specifically remember you explaining to me and our other brother the concept of the whole thing, and I was like, you've gone off the deep end. This is insane. This just reeks of just some crap scam, something like this makes no sense. And I never could grasp it. And here we are. I'm finally coming around.
And I'm out.
And, and you're gone. But yeah, I mean, that, like, what really brought me around, like, I'm only, you know, like I said earlier, I'm only just, you know, probably about 7-8 months really head down and studying all this and learning and catching up to speed. And really what started was when, you know, I've obviously known about Bitcoin ever since way back then, 2010 or whatever. And I followed it from the sidelines, and, you know, I'd see the price shoot up and skyrocket, and I'd be like, this is stupid. Like, when's this thing going to blow? And the reason I dove in as deep as I've gotten now is just the feeling of, it's not FOMO in the natural sense, but it's just this, like, how is this still going? And not only is it still going, but it's getting bigger and bigger and bigger. And now it's this entire thing. Like, what am I missing? There's got to be something I'm missing. Because, I mean, just a year ago, like, I would look at all crypto and I'd say there's Bitcoin and then there's everything else, and everything else is just crap, and it's all just trying to mimic and copy Bitcoin. And those coins do exist, but I have found that there is a lot of very cool functionality to a lot of the stuff that's out there. So, but that is coming later. So diving in, what is a blockchain? So a blockchain at its very highest level is a distributed database of information. So traditional databases are stored in tables and centralized. And what's happening here is kind of like we've alluded to so far. A block is formed, it is linked together, and that is decentralized and distributed all around the world to anybody running a node, quote unquote. And what this data is it's a public ledger of secure and decentralized transactions. It's secured because, you know, it's logged. It's relatively anonymized. You know, I mean, everybody's wallet is public knowledge, but you don't know whose wallet is who unless you show somebody what your address is. They can't do anything with your address other than send you stuff, or monitor or watch your activity or whatever. But the data then is, like we said, structured into these blocks. And so basically what happens is a block is, when a block is forming, you know, let's just analogies need to be strong on this one. So just picture an open bucket, an open block, and it's just constantly getting filled with many transactions up to a certain block limit size. And then once the block is full, it goes ahead and it closes it up and it submits it to the nodes on the network to be verified, but also to be signed. And once it is signed and verified, it goes in that order first: sign it and then verify it. And we'll get into both of those. It's verified. Once it's verified, it gets inextricably linked to the block that just was formed just before it, hence blockchain. And once it's locked, it is locked. It is never going to get reopened. It can't be reopened. It can't be changed without like a dramatic hard fork of the network at that block or whatever. And so some of the way that works is you'll see on a number of coins, there's a window of time where X number of confirmations have to happen before it's truly locked into the chain. And what that is that's the verification process of, let's say it's 130 confirmations are required before that block is truly added. So the block gets closed up, it gets signed, and then in the verification process, it's just a giant gossip network. And so all these computers are chattering up together. They're saying, hey, did you hear this? Did you hear this? And everybody's going, let me check. And, we'll get into how they check it. They'll check it. They'll verify. They say, yep, that checks out to me. I heard the same thing. And every one of those is kind of a confirmation that's happening as it trickles around. And then eventually we get that 130 confirmations from everybody. Actually, 130 confirmations of majority of the network. And it gets frozen. So while that's happening, more blocks are getting linked together. But that's the whole point of the 51% is they're all getting linked together. For somebody to try to spoof that is you need to control the majority of the network to be able to trick the network into thinking that your fake transaction happened. And that is, as we'll see, virtually impossible on any of the established domains that you've certainly heard of. One thing that a lot of, like, Bitcoin started this, there's a number of chains that operate on proof of work. And so the blockchain, like we said, is sealed with a specific value, which we'll call a hash. And it's generated via the SHA-256 hashing function, which is that cryptography piece of the equation. The hash solution, that's the signage that gets passed around the network until, like I said, the majority of the network agrees that is the correct, and therefore they have consensus that is true, and then it gets locked in. And so that, recapping there, that means 51% attack is a real thing. But on these established blockchains, it's virtually impossible due to the sheer amount of capacity that you would need to hold to have 51% of the network. So SHA-256 is a very important, but also can be very complicated to understand. So we're going to try to keep it super simple. The green box there is the SHA-256 hashing algorithm. All you need to know about what it does is you give it an input. You could give it one word, you could give it one letter, you could give it the entire encyclopedia, and it will always spit out 256 bits of data. And so that's what you see there on the right side is you see 256 bits of random, or what appears to be random ones and zeros. And as we know, computers take 4 bits and they can turn that into a letter or a number in accordance to the hexadecimal numbering system. The only reason, so the hexadecimal system goes from 0 to F. So A, B, C, D, E, F. There are no other letters. And so those 4 bits equate to 0 through F in the hexadecimal numbering system. So what we see here is this is a real SHA-256 output. If we put in Blockhead Traders with a space in the name, we get that output number 1 that you see right down here. And then if all we do is take out that space, everything else is exactly the same, and we get what we see down below as output number 2. And you can just just quickly compare them side by side. They are completely different. And all we did was remove the space. Everything else was exactly the same. This is by design and by intent, because that keeps the algorithm from being predictable, which keeps it from being hackable. But the important thing we want to focus on here is the fact that you could change the tiniest little thing and you get a completely different output. And that's going to come into play in just a minute as to how that signage works that goes on the block. Going into then miners and mining, because that's how this currency gets formed. Like we said, you're by mining the coin. So we're only talking about proof of work algorithms for now. So your Bitcoin, your Ethereum, and then there's a number of other ones that do CPU mining, Monero, Raptorium, things like that. Those are all proof of work. And so what's really happening is you have the block on the network, and it's getting filled up with all these transactions, and then we're getting close to sealing it up. This block is already linked to the one that came before it. When it gets all filled up, it's going to have this tiny little bit of extra space left over, which is where the signature needs to go. And what that signature is so like we said, we're just going to use the word basically these transactions will be one long string of data, and you'll throw that string of data into the hashing algorithm, and you'll probably get something that looks like output 1 or output 2 here. And specifically what we're looking at is we're looking at the end of this not equation, but the end of this value. And so what's important to know, let's just pretend output 1 was a block that was found on the chain. Depending on the difficulty that's currently set, which we'll discuss in a second, let's just focus on these final, what is that? 1, 2, 3, 4, 5, 6, 7 digits. Currently, they are all non-zero. In the case of signing a block, given a specific difficulty, we're going to want, this number, which we'll just say is something like this. And then the final 7 digits, we're going to want all zeros. And like I said, the difficulty of the network determines how many zeros you need to have at the end of this thing. So initially we have our chunk of data, the word we hash it through the SHA-256 algorithm, and we don't have any zeros at the end. So now is when mining begins. This block's data has been transmitted to the network, and now everybody is doing millions of hashes per second to say, okay, the 1. If I do the 1, do I get 7 zeros at the end? Nope. The 1, 2. Nope. The 1, 2, 3. Nope. And that's mining, is just crunching over and over and over and over again. What is the signature? What is the number that I can add to the end of this that comes up with 7 zeros at the end? And whoever finds that gets rewarded with a newly minted coin on the network. And so these are coins that never existed before. So it is inflationary, adding value to the network. However, none of these coins are purely inflationary, meaning they have a fixed limit. There is a total coin supply. And not only that, but like I said, difficulty is determined how many zeros we need at the end, because finding each digit zero is not linearly more challenging. It is exponentially more challenging to get 2 zeros than 1 zero, and so on and so forth. So the more people that are mining, we can't just have all this money burst out all at once. And it has to be trickled out slowly, deterministically, methodically. And so there are 2 functions to that. One is the difficulty, add another 0, require another 0 to sign a block. The other one is having the block. So like Sprocket said, back in the early days, Bitcoin started, 1 block reward was 50 coins. And now it's down to, I think, 6 or 7, 6.5 coins, something like that. And that's because every 3 years or so, the rewards get halved. And the thinking behind that is, as you go on, as time goes on, the coin gets more valuable. So when you have the rewards, you are getting less, you are getting half the rewards. However, the rewards are worth more. And so you're making the same amount of money. And it's also controlling that faucet of how many coins are hitting the marketplace. So that's the total coin supply. There's also the issue of block processing speed, or not really block processing speed, but transactions per second. And that is going to play in here in a minute. But essentially, that's just saying how many transactions per second can this chain support. And in the case of Bitcoin, I think we're sitting at something like 7 transactions per second. In the case of Ethereum, we're sitting at anywhere from like 10 to 30 transactions per second. And that is a huge problem if the network is getting pounded with a lot of transactions. And really what that alludes to, or what that causes, are these things called gas fees. Now, this is a brand new concept. I meant to look before this video, but I don't believe Bitcoin has an issue with gas fees. I think that's primarily because Bitcoin's role in the world is to be the gold standard of value. It is doing nothing but just being value. So equate it to a bar of gold in real life. It's not trying to do anything fancy. It is just money. It is digital money. That's it. Ethereum basically came along and said, hey, we could do so much more with this. We're going to be a store of value, but we're also going to add a lot of this other functionality. And part of that was we need to be able to process more transactions per second. And they're sitting at 10 to 30 transactions per second. But that is a huge problem because the Ethereum network is now getting just heavily loaded up with all sorts of decentralized applications and things that are submitting tons of transactions to the network. So if you can only process 10 to 30 transactions per second, there needs to be a priority scheme in place. And that's where gas fees come into play. If the network is heavily congested, gas fees go up. And this is a way to prioritize what transactions get pushed through. So essentially, you're in a bidding war if you're trying to send transactions on the Ethereum network. And there are plenty of tokens and blockchains that try to alleviate this pressure. But at the end of the day, if you're trying to send a transaction at a peak hour when there is a ton of congestion on the network, it is brutal. I mean, we're talking $75 in a fee just to send somebody $20 or something to that effect. It's been as high as $150. And there's moments of a gas war. Like, I don't know. I mean, somebody with a ton of Ethereum just wants to cram a transaction through. An all-out gas war is step away. Just whatever you're trying to do is not that important. So like I mentioned, there's coins and there's tokens in this world. Coins are the native currency for any given blockchain. So for example, Bitcoin is the native coin of the Bitcoin blockchain. Ethereum is the native coin of the Ethereum blockchain. And more important, the blockchains are not compatible with each other. So you can't directly take one Bitcoin and send it to the Ethereum network, or vice versa. You can't take an Ethereum and send it to the Bitcoin network. Some of the top coins right now, by far, not an exhaustive list, but the big names that you'll hear a lot of are Bitcoin, Ethereum, Polkadot, Stellar Lumens, Solana, Monero, Litecoin, Cardano. Those are some of the really big ones, and I'm even missing some of the big ones, but those have been around, they've been established, and they all are trying to do very specific things with their blockchain. Just for real quick example, like I said, Ethereum tried to do a bunch of enable smart contracts, is what they're called, where you can bundle things for an application and throw that into a box. And we'll go into an example of that.
Yeah, there's a difference, I think, from what I understood, right? So when Bitcoin's all I know, but one of the interesting things about Bitcoin is there is going to be a finite number of Bitcoins that could ever be produced, the way that that whole thing was set up. But I hear
Yes.
that there's these coins out there that don't really have a limit and they just kind of keep dumping things in the world. What's going on there?
Those, uh, I have yet, and I'm not saying it doesn't exist, but I have yet to see a true, legitimate purpose to an inflationary coin or token. Usually it's a token, like Shiba Inu is a token and it is purely inflationary. There is no cap. However, Dogecoin is an actual coin. It has its own blockchain. It as well is inflationary. There is no cap. Um, and they claim to have, and again, I'm going to sound like maybe I'm talking bad about certain things. I'm genuinely not, but I do not have a full understanding. They claim to have a use case that doesn't matter, that it's going to continually decrease in value over time. Uh, I don't know what that is. And obviously, a number of these, like Shiba and Doge, started as memes, and then all of a sudden they caught hold. Uh, you know, Elon Musk tweets about something, and then all of a sudden everybody thinks it's legit. And so, uh, so there, I do know that Dogecoin, there is a lot of now retroactive engineering or work going into making it, continuing to try to make it more legitimate because it has, caught so much fire recently. Dogecoin is an example where they're trying to add functionality to it now that it's no longer a meme and people are actually trying to use it, et cetera, et cetera. So the short answer is, for an inflationary coin or token, I have never seen a legitimate, like, this is how this thing survives. Going into tokens are the native currency of we'll call it an environment that runs on top of a blockchain. So that is to say that a token uses the infrastructure of a specific blockchain to package and send its transactions while accomplishing some completely different service or purpose. So this is essentially renting the blockchain. And so these tokens we see here that I have listed: Uniswap, Polygon, Flashmatic, Axie Infinity, PancakeSwap, The Graph, Aave, Sand, Mana. These all exist on a particular blockchain. Most of them are on the Ethereum blockchain. And so this again is getting into that decentralized apps usage, smart contract usage of the blockchain. So this is how, if you have an idea of, oh, wouldn't it be cool? So let's just do a little preview of the crypto gaming. Axie Infinity is a game, and you play the game and you earn, for winning in the game, you earn in-game currency. This is not a new concept. Plenty of games give you an in-game currency for winning, and then you level up your character, you buy this or that with it. The difference is this in-game currency exists and can be traded and can be cashed out to other currencies. And tokens have many different purposes, but one of the things that they do is they allow uh, transfer of of Bitcoin to Ethereum. Like, there's services there. It's not just the tokens. It's the decentralized apps, the dApps, that do this. So if you have the idea for this game, where you're like, I want to build this game and we're going to have this cryptocurrency in the game that users can basically earn real money playing the game in a totally legit way, not in the way that it sounded shady 5 years ago. And but we don't want to build a blockchain. We just want to utilize. We want to rent time on the Ethereum blockchain. We're going to package all our stuff up, and then we're going to communicate with the main blockchain, the Ethereum network, and then it's going to handle, actually logging and ledgering, or all that kind of the back end stuff of that. So tokens, they still are a thing. So Axie Infinity, AXS, or SLP are the two tokens that are associated with that game. They still exist and they still have their own ledger of sorts for in-game transactions. However, then they lock all that, they send it off into an Ethereum block as a smart contract to get locked into the blockchain, as we discussed, through mining. So on that note, the early days of Ethereum, there was a new game. And so in the early days of Ethereum, the world only knew that rudimentary view of Bitcoin and crypto. And that was it's money, it's just traded back and forth. So there was this thing back in, I think it was around 2017, called Crypto Kitties. And this was kind of, as far as I know, the first major appearance of NFTs. And so we're not going to completely get into NFTs right now. But suffice it to say, they were collectible cats. They were pictures of cats. And it was a game, and you could trade cats with other people. You could get two cats together. You could breed and have kittens, and then those kittens have different traits to them. And they were eventually worth value because everything was randomized on a scale of rarity, as far as there's only one cat in the world that has golden eyes, or whatever. And so in the early days, you had, let's just say the Ethereum network is just humming along, doing its thing, making blocks, and on a hyper view or hyperscale or whatever, these blocks are primarily filled with just Ethereum transactions, people sending money, people staking, whatever. And then all of a sudden, CryptoKitties comes along, and now we're getting squeezed. And like, there's only, a tiny portion of the transactions are those original, Ethereum transactions. And now all of a sudden, the rest of the block is just getting smashed with these CryptoKitty transactions. And at one point, I think 99% of the traffic on the Ethereum network was related to this CryptoKitties game of people playing CryptoKitties. It just caught fire. It went viral long before the Ethereum network could handle traffic on their network going viral. And this was almost the end of Ethereum because it did not handle it well. I haven't fully studied the entire thing, but obviously they came out of it and they made a ton of changes to the network to better facilitate that situation. However, obviously one thing that they were not able to resolve yet was the whole 30 transactions per second thing. So on the main net, which is what we're kind of looking at here, you basically have, the types of transactions that are going on Ethereum mainnet are people staking their coins, people paying for things with Ethereum, transaction approvals, the whole mining, the whole validation thing. And then you have these sidechain interactions or smart contracts. And those are what, this CryptoKitties thing started to do, or revealed the Ethereum network would need to be better at managing and handling. And so a side chain. So we're going to talk just real quick about what a side chain looks like, because again, that's a token. And in this case, we're going to take a look at Polygon. And it's known as a layer 2 scaling side chain, and it interacts with the Ethereum mainnet. So basically, we have the Ethereum mainnet over here, and these blocks, we'll just represent it as that. And then now over here on the side, we have a completely different network, and this is Polygon, and it's a token. And so it's humming along and it's doing its thing. It's Polygon's purpose is to try to bridge a lot of different coins, a lot of different tokens, but it's a side chain of the Ethereum network. So what's the main value of Polygon is, like we said, Ethereum can do 30 transactions per second. Polygon can do somewhere on the order of 65,000 transactions per second. By comparison, I believe Visa, MasterCard, I think credit cards in general might be pushing under 1,000 transactions per second as to what they process. They potentially can process more. We just don't know because they've never had to. However, obviously, 65,000 transactions per second resolves a ton of issues. And like we said, let's call it generously, let's call it $20 to send a transaction on the Ethereum network. To send a transaction on Polygon, last time I did it, it was maybe 5 cents to send a transaction on Polygon. And so the way Polygon does this is they have a ledger on their network, and then what they do to the piggybacking off of the Ethereum network is occasionally they'll just take a snapshot of everything that happened. So they're not sending every transaction to the Ethereum network. They're running their 65,000 transactions per second. It hits a certain level. They take a snapshot and then they send that one snapshot over to the Ethereum network. The Polygon network handles that $20 fee or whatever it costs to send that on, to lock that into a main Ethereum block. And then you can do transactions more rapidly and at a much lower fee.
So what I'm hearing here is the Ethereum network is your spinning hard drive and the Polygon is your cache.
But yeah, basically your main net is running way slower. And then you're caching a bunch of data and then just sending big chunks, dumping them onto the hard drive to be locked away. And that doesn't mean you don't have to touch Ethereum mainnet. So just moving things around as I'm trying to, go from one exchange to the other or buy a specific thing. Occasionally I have to touch Ethereum mainnet, and those are sad days. However, there are a lot of gas tracking websites that help you find an ideal date and time. Sundays are usually low, and I mean low relative. And unfortunately, like 2 a.m. to 6 a.m. East Coast time is also low. So, but I use Polygon a lot, especially as I'm mining. I will get my mining payments on the Polygon network because that way I'm not paying a gas fee to get those payments sent to me. I'll let them accumulate, and then there's a whole chain of things that I send it through different tokens in order to get it to a final destination with the intent of kind of avoiding some of these gas fees. Without a doubt, you're sitting there wondering, why should I even care about this? Like, what is happening? And honestly, that's hard to answer. However, just a few stabs at it, I would say there's this obviously continual digitizing of our lives. And so it would only make sense that, a digitized finance system that was built to be digitized, not that is built to adapt to a digital future, makes sense. The primary focus of all cryptos that I've seen, and we'll just say legit cryptos, is security through decentralization, as well as, like we said, there's no creating fake transactions, on any of these well-established blockchains. And that is to say, as far as the decentralization, one major corporate entity is an easier target than thousands and millions of targets to compromise, to steal somebody's money or not. I mean, you can steal it by social hacking. Social engineering is always going to be a threat, but there's less of a centralized system, a centralized database to hack and get information from and whatnot. Decentralization also gives more opportunity for, quote, the people to directly own and manage their digital assets. At this point, we are talking assets. We're not just talking money, though money obviously applies. But like I said, in the case of gaming, you've purchased this character, you've spent time to level them up. I mean, for all intents and purposes, you've poured a lot of ownership into that character. This system gives you more power to own that asset and do something with it if you want. If you want to sell it to somebody else, you can do that. And then, I mean, it also gives you power in staking, and it gives you voting powers. I mean, you become a stakeholder in these networks, whether it's a decentralized exchange, If you hold specific tokens, you have voting power on what happens in the future of this network, and it gives you that ownership, that stake in what's going on. And I mean, now with various financial solutions established, developers can then start building games and applications around a digital economy, which opens up entirely new opportunities both for creators as well as consumers to participate in this digital future. Um, so those are some reasons I care about it. I mean, it's not just the, you know, the wild and crazy investment opportunities that are out there. Those don't hurt, but I do think there is a serious future value in a lot of what's happening right now. Part 2 will be coming soon. That is going to be NFTs, dApps, DAOs, and DeFi, which is decentralized finance. Stay tuned for that coming up. What say you?
Well, it was that was a lot of information, a lot of interesting new use cases for them. Ironically, I think the last slide that you had where you talked about the things about why should you care, one of those particularly rang true to me back when Bitcoin first was out there, and that was really the whole decentralization of the currency and what kind of interesting impacts that could have on society as a whole. A lot of governments and stuff will kind of assert their control over their ruling area by the manipulation of currency. And there's a lot of currency manipulation that can go on, good, bad, like intended manipulation, bad manipulation, and so much influence that just goes out the window if a wide population would adopt a decentralized currency where there is no central control of that. And so that's always been kind of interesting to me. And so it's kind of natural that all these other things that you mentioned kind of fell out of that. I remember talking to a bunch of people back then when Bitcoin was coming out about all these potential use cases and potential things. And it's just kind of cool to see them kind of coming around now. Sometimes I wonder how much of this type of stuff happened when, credit cards started coming out, right? I know it's not really the same thing, but it's a transition from one way of thinking about things into a different way. And I'm sure there was a period of time when there was credit cards and people are like, oh yeah, plastic, we'll just charge it. And now there's places that don't even, my kids went down to Kings Island and, towards the end of the summer, in the fall, the place doesn't take cash. There's not a single place that takes cash. Like you go to play those little carnival games, you got to go buy a stupid little plastic card and put money on it so you can play the carny games. I can't pull out $1 and give it to my kid and be like, yeah, sure, go play that game, whatever. So yeah, it's kind of interesting to think about that. And I think if you really look at, you mentioned the number of transactions Visa and MasterCard and stuff do. If you just think about the number of financial transactions that exist in everyday methodologies today, the scope and the market share for crypto transactions is actually really big. Because what can you buy with Bitcoin today? It's a lot more than just the VPN service that I could sign up for, 10 years ago. But it's nowhere near like, oh, McDonald's, let me pay with Bitcoin. At least I don't think so. They don't take cryptocurrency at McDonald's yet, do they?
Not yet, but Starbucks and McDonald's, I think, have started talking about doing NFTs for something. So I mean, give them time. Yeah, they'll figure out how to mess it up. Yeah.
So from that aspect, it's pretty exciting, and yeah, you definitely also tossed out a ton of terms that I'll probably have to exercise my Google foo on. But
yeah, I think to me, crypto has the potential. I mean, it has the potential, and it also is this insanely great equalizer around the world. And what I mean by that is we'll talk about it more on the crypto gaming episode, but that Axie Infinity game There are people in far worse off, underdeveloped areas of the world, like the Philippines, where they are supplementing their entire income, if not able to live off of what they make by playing the game. And that is just to say, because it's digital, because they can earn it, they keep it, it's theirs. They're not going through some institution. They can go buy things online with it or transfer it to something else that they can go buy online. Um, like that's a pretty cool reality of what's happening right now, where um, you know, you don't have to worry about the economics of a particular area to survive or have a livable wage or whatever. Um, and I mean, there's other use cases that I don't know, it's not on deck to get into, but I would love to at some point, of ways, this wrestling away of power or monopolies in an industry and giving that power to people in a decentralized way. Uh, one that I would encourage people to look into is the Helium Network and the way that that is trying to change the landscape of telecoms. Um, and it's a big thing to absorb. But I mean, it's, what it comes down to is why why does the telecom industry have to be owned by two or three giant corporations? I mean, it's because it's so expensive to get into, but why can't we have a public owned, by the people kind of network? So things like that, whether you want them or not, I mean, that's the power of what we're dealing with here, that it makes those things possible.
Well, that certainly was a lot of content there, Viper. I am kind of looking forward to some of the later parts in the series. Uh, Most notably, I've been seeing in the news these NFT things going for tons of money, and then I also hear people talking about buying these little like avatar sets with these NFT avatars, and so that's I'm kind of looking forward to the next part in the series of that. But even more so than that, how is this going to fit into trading? I know that you've been scalping crypto currencies. I know you've been mining cryptocurrencies, and so keep explaining the backstory here, and it'll only kind of get me more excited to actually jump into those final episodes in this series where we might actually get into some of the exchanges and make some buys and sells. And so I do agree with you. I think knowing a lot of the content and the why and the who and the what is very important contextually. So it's more than just jumping into a particular, whether it's an underlying a particular future, cryptocurrency, kind of understanding a little bit at a high level. What is this thing? What does it do? How does it do it? Um, I think is important. I think we covered a lot of that. I kind of equate some of what we're talking about here loosely to like a company's fundamentals. Okay. Like when we go trade underlyings in stock,
Yep.
we don't say, oh my gosh, we got to study the books. We got to look through the financials. No, not to make trades. You got to kind of know, what do they do? What's their core thing, and how's that industry doing? Like, okay, if you want to dabble in a couple price to earnings, something like that, that's fine. But to just make short-term trades and understand what you're dealing with, this is the type of information to get over.
Yeah. Yeah. I'd 100% agree, because it's important with how many bad coins and tokens there are out there, that to be able to look at something, say, give me the thesis, give me the final thought on, what is this coin doing? What are they targeting for? What are they trying to achieve? You can filter out a lot of crap that way. And that's key to me, is having that understanding, that foundation context, to be able to look at something and go, that matters, that doesn't, that matters. And, then you can go from there. So that's what it's all about, really.
Yep, absolutely. So with that, hope you enjoyed our little tour here, or appetizer in the crypto world, just kind of talking about some of the origins of some of it and some of where it's kind of headed and just the high points of it. Looking forward to the next part in the series. It probably won't come out sequential to this video. I think we'll have a couple other things interlaced in there, but it is a series we're going to kind of continue. And love to hear your input. What things do you want to know about crypto? What are you interested in? Hop in the Discord, leave a comment on the video below. I'm sure the bots will be with you this time, commenting right alongside of you. They'll probably give you weird names to go watch on YouTube videos, but we'll take all of your consideration under advisement. And yeah, we'll tailor the stuff in this series. I know in the Discord, there's been a couple of users that have reached out to Viper and a couple other members in there specifically about crypto. So just, hey, ask your questions, man. We all start somewhere. I'm starting really at zero, close to zero. It's been away from crypto for so long. So let us know what you got going on. Otherwise, good luck this week. It's going to be a shortened trading week with the Thanksgiving holiday and everything in the U.S. and the bond markets. We'll have strange hours on Friday. So check all that before you trade. If you're going to eat some turkey, enjoy your family. And remember, think outside the block.